We're going to start on time. First of all, I want to welcome everybody to the forum. I'm going to do the introduction in English. And I'm going to do a brief introduction of why we're doing this seminar, and a little bit for those who know us and don't know us, who's trusted and how our relationship is tied to Oppenheimer. But first of all, I want you guys to know that these forums are very selective. We don't do many of them, and when we do them, we usually invite family and friends and close clients, because we want to try and get you in touch with the best in class speakers, so you guys can take advantage on the access that we have directly. And these are folks that have basically a lot of experience and are best in class and a lot of knowledge. So we're going to have several of these a year. So I encourage you guys to make the time for it, because in these times, we all need guidance. Everybody's living, we're living different times, and whatever information we can get to help, manage our risk, our investments, and our goals is important to everyone. So a little bit of our background. I'm going to go brief because John doesn't know, and probably a couple of you don't know. I've been in the business not as long as John, but I've been in the business over 25 years. I started my career in Citibank. No, I started my career in ASA, in the insurance business, where I learned to know a little bit about insurance risk management. Then I went to Citibank. That's where my financial career started. I transferred over from Citibank after 5 years to Wall Street Securities, which was the leading investment brokerage firm in Panama. In those years, we used to clear through Payne Weber. I'm pretty sure you remember that, John.
Yeah.
And that, Wall Street became the leading investment a brokerage firm in Panama. And there I helped introduce, all the products, all the mutual funds into the system. Then I went to work for Morgan & Morgan and helped them set up what now is one of the best, private banks in Panama, before founding Trusted. And just as a brief point, I founded Trusted about 11 years ago because, none of the banks or the brokerage firms offer what we offer. I mean, we basically offer non-traditional consulting services to clients. That means we have a planning model. We try and help clients understand risk. We don't sell products. We basically try and help clients identify their goals, identify their needs, and basically how to manage their cash flows through a process. And in this business model, we try and work with the best in class managers out there. I mean, we seldomly manage the money. We outsource most of the money. If the client wants to manage their own money, we try and book them in the right places where they can do that. But it's a very consultative approach. And, we've been pretty successful at it. And we've been in the business for a long time. We have a good group of people here. Part of the good people that we have here is the group of Oppenheimer, which was introduced to us by Glenn. And I'm going to pass it over to Glenn so he can present Oppenheimer. So I welcome you to the conference. Take advantage of it. John, you got a good group of people behind you here in this conference. So a lot of Q&A, and I'll transfer it over to you. Glenn.
Yeah, well, we're just, good morning, everybody, and thank you for joining. We're also thankful for John Stoltzfus to be our guest speaker today, to give sort of the insights of today's market, especially in these times. We all have a concern as to where we're going and what the future holds for us in these times of inflation, in times of COVID, in times of war, in times of Fed rate hikes. And John today is going to go over his viewpoints and thoughts on those topics. We're going to have a Q&A afterwards where you can have direct comments or questions to John and to get his opinion on what he's going to speak about today. We also have on the call today Carl Rozak, who is the investment manager for Oppenheimer, and also is the one who has introduced us to Oppenheimer here in Panama and into Trusted. And we're thankful for Carl for his relationship with the team. John, many of you may have seen him before. John is a frequent guest on Bloomberg and CNBC, among others. And Maria Alejandra is going to give John's bio, and then after that, we'll send it off to John. So can you please, she's going to give it in Spanish so everyone can understand it a little bit more clear in Spanish. Go ahead, Maria.
Bueno, muchas gracias a todos por darles la más cordial bienvenida y agradecerles a todos por acompañarnos a la conferencia en alianza con Oppenheimer. Les saludo María Alejandra, encargada del área de mercadeo. Nuestro invitado especial de hoy, John Stoltzfus, es jefe de estrategias de inversión de Oppenheimer, veterano del sector de los servicios financieros con más de 30 años de experiencia en los mercados. Su trabajo hace hincapié en el análisis de mercados y múltiples clases de activos combinados en estrategias de mercado global. John sigue las tendencias cíclicas y seculares, los sectores, la geopolítica y la macroeconomía. Es conocido por las oportunidades potenciales que ofrece su análisis y por su redacción y presentación, a menudo muy ingeniosa, tanto para los clientes como para los profesionales financieros. Sin más preámbulos, le doy la bienvenida a John.
It's all yours, John, and thank you.
All righty. Well, very glad to be here. Es un placer estar con ustedes hoy. Sí voy a hablar en inglés porque generalmente en la bolsa, si estoy en Nueva York o si estoy en Latinoamérica, se me parece que ustedes hablan el inglés mejor que yo hablo el español, particularmente cuando se trata con la bolsa y la tasa de interés. And that's it for my Spanish at this point. It is very much a pleasure to be with you today. These are periods under great transition around the world. As it was mentioned, I have been in this business for over 30 years. To be more exact, I've been in it for over 38 years now. So I'm in my 39th year. Sometime between May and July of this year, I forget what the month was that I reported to my first job on Wall Street. Among the firms that I've worked with along the way, I've worked with Morgan Stanley at Morgan Stanley headquarters, Chase Bank, long before it bought JP Morgan. I also worked with Bank of America, senior market strategist on the buy side, and several institutional firms along the way. I've been with Oppenheimer since 2012, so I'm coming up on a 10th anniversary. And I would like you to know that this is my favorite firm of any firm that I've ever worked on. The particular reason why it's very good environment for thoughtful procedures in developing strategies and in being in a position where I'm highly accessible to both the advisors, the institutional representatives, also as well as the clients through their representatives of the firm. We publish on a weekly basis. We also publish a monthly chart book, and I'll reference a few slides from our monthly chart book as I go through my presentation. I'm not going to speak too long because I want to really listen to your questions and be able to respond to them. So we are in a very much a transitional position. This has been, the last, we just celebrated the 13th anniversary of the crash of 2009 when the S&P 500 went through 666. That created no end of thoughts by many people about what that meant as an intraday low for the S&P 500, and it closed around 674, I think, or by the end of that day. But that was the bottom. And prior to that, the S&P 500 had lost some 47%, as I recall, in 2008. It was due to the housing crisis and the financial crisis that came out of that. It was fortunate that in '08, we had Ben Bernanke at the helm of the Federal Reserve, and he changed the Federal Reserve in the US significantly in that it became much less secretive, it became highly transparent and much more communicative. And as a result of that, the policies that he put in together with Hank Paulson, who in '08 was the Secretary of the Treasurer, they put together a great rescue program. And in 2009, we saw the S&P 500 actually fall from a peak around 27% in the first quarter. But for the full year, it was up over, I think, over 23, 24%. We'll actually see that a little bit later for that year because of their efforts that put enough liquidity into the system to get business and the consumers to do what they do best, which is to do business and to shop, to spend money, and to hire people and get to work. And it was a great time. It was 13 years, notwithstanding some pullbacks. And Maria, if you would show us, I think the chart on page 5, if you would, that we have, if you could show that chart a second, page 5 of the chart book. It's the only one I think I didn't give you, mentioned it up front. But our point with it, while she looks for that chart, is that stocks don't go up in a straight line. From that low on March 9th of 2009 through February 19th of 2020, when that bull market ended, the S&P 500 suffered several declines during that period. It wasn't a smooth exercise upwards. There was no bell that rang that said it's all clear, it's a good time to invest. And in the process of all that, as you can see, thank you, Maria, you'll see that the S&P 500 from the end of 2008 experienced a number of declines. So it wasn't easy, you know, and it in that process, it included this 33.9% drop that you see just before the more recent drop, which was from February 19th to March 23rd, barely a month and 4 days, in which the market declined on negative projection by investors and traders as to what was going to be the outcome of the pandemic. And the pandemic, as we all know, back in 2020, in April of 2020, the thought was by many, I put quotes on this, some of the smartest people in the room, you know, that in those days thought that it would take years to find a vaccine, that it looked like the end of the world as we knew it. And what do you know? It was in an environment where we have advanced technology today, like at no other time in the history of the world. They came up with a vaccine in 9 months, and look at us now. If it wasn't for Vladimir Putin, we'd probably, I'm not saying we'd be dancing in the streets, you know, but we most certainly would be a lot more relaxed than we might be on any given day as we judge what are the implications for commodity prices globally and all as a result of Vladimir Putin and Russia's incursion into Ukraine, which has disrupted not only life in the Ukraine in a most tragic manner and a brutal manner, but has also disrupted further the global supply chain. So in our thoughts here is that overall, stocks tend to go up more of the time than they decline. When they decline, however, it can be rather dramatic. Some of the things that can bring stocks down are financial crises, exogenous shocks like a pandemic, or development of a military incursion that has global implications. Okay, a variety of things that can occur. But the overall thing is that business people in general are not like deer in the headlamps of challenge. If anything, the best of business looks to see how can we profit from this problem and bring about a solution that will get us back to a more normal point. And there never is, once again, a point where you can say, all's clear, it's perfect day for investing. In my experience in 38 years in this market, there is always an opportunity for somebody to say, looks bad, I don't know what's gonna happen. Because what the bullish case is the hardest case to argue. The bearish case, since mankind and womankind landed on the earth or were placed on this earth, has always been, my gosh, based on humanity, it's amazing that we're here. But somehow we managed to move forward and actually make great progress. So where we are today, if we look at, and you don't have a chart on this, but I'll give you some numbers. When we look at the global markets, we see in terms of the US, the Dow Jones Industrial Average is down only 4.28% from the beginning of the year, okay? It's down more from its peak a little bit earlier in the year, but it's down from a year-to-date basis, which is generally what you look at over a 12-month process. It's down 4%. The S&P 500 is down 5.49%, and the NASDAQ is down 10%. Now, it would have been much worse had we spoken last week, but we've had a set of remarkable rallies that we were experienced over the last few weeks, and not an intermittent testing as we go forward. What this is all about, the question is what's the story on inflation? What is the Federal Reserve going to do? Well, as I mentioned earlier, we have, as a result of Ben Bernanke having been Fed chair of the Federal Reserve, we have a transparent and highly communicative Federal Reserve. Now, Bernanke is no longer the head of it after the tenure of Janet Yellen, who followed him, but also practiced his methodology. We have Jerome Powell, who is very similar to his two predecessors. The only difference is, and this is a personal comment, I don't think he's as good a communicator as they were. He's not, and this is not a criticism of the guy personally. It's just objectively as a strategist, I think the market trusts him. The market never trusts the Fed chair, okay, because the Fed chair is always involved leading the Federal Reserve, and the thought is, is the Fed really going to help us? Is money going to be affordable to borrow? And what's going to happen? Are they going to raise rates too high? But I think his heart is in the right place. And the wonderful thing is, in 2018, we saw his ability to pivot. In February of 2018, Jerome Powell became head of the Fed after Janet Yellen's term had ended and Donald Trump decided not to renominate her. And when Jerome Powell came in, he inherited a Fed fund a hike cycle. So the Fed was raising rates. It had begun raising rates in January of 2015, and it had raised regularly 25 basis points at a time. By February of that year, the market was getting kind of nervous because interest rates kept going up. It wasn't necessarily suffering, the economy wasn't necessarily suffering, but the market was afraid that if he kept raising, he could push the country into a recession. Well, he kept raising for quite a while, and the market got nervous. In 2018, the 10-year yield went to as high as 3.11 in the first half of the year. And then the 10-year Treasury yield went as high as 3.25 in the second half of the year, in the fourth quarter. In the fourth quarter of that year, the S&P 500 declined some 19.8%, almost 20% into another bear market. And that convinced Jerome Powell to pivot, and he did. He stopped raising rates. As a result of that, the stock market rallied. That decline of 20% in that year was overcome so quickly that for the year, the S&P 500 in 2018 was only down 7% and change, okay? So it wasn't a bad year at all, relatively speaking, versus the decline it had had at one point within that year. And in 2019, the market made back all that it had lost and added some. It was up some 20-some%, as I recall, or 19% that year. And it wasn't until 2020, when we had this pandemic, that it ran into trouble. The good news was, when the pandemic happened, the Fed applied significant levels of liquidity. It added debt onto its balance sheet. It bought treasuries to the tune, as I recall, of about $80 billion a month. It lowered its benchmark Fed funds rate, I think, from around 2 and change to a band of 0 to 0.25, much like the band that had been placed when the economy had gone into the housing and financial crisis in '08. And as a result of that, the economy responded very well. In fact, the recession that was created by the pandemic lasted only 2 months based on the official arbitership of the conference board, which determines the length of a recession. It was only 2 months long. Essentially, it was late February to early May, early April. Extraordinary. However, there were segments of the U.S. economy as well as the world economy that were not able to reopen until COVID became much more manageable as a result of the vaccinations, the vaccines that came available over the next 9 months. And in that process, there were experiences of supply chain disruption. Now let's talk about supply chain. The biggest problem with the global supply chain today is that all roads, remember, all roads lead to Rome. Today it is all roads lead to China. And the supply chain leads back to China so very often, an extraordinary level, in so many different ways, whether it's processed materials, manufactured goods, whether it's in technology or household goods, what have you, chemical processes, pharmaceuticals, go figure. And their business has been reluctant to diversify away from China because China could deliver a very good level of quality at a very low price. If you think back to it, somebody like me who's been around a long time, I can remember, and I'm half Mexican, okay? So I know about maquiladoras in Mexico. And there used to be a time when so many things were made in Mexico before they got to the US or assembled in Mexico. When China really rose to prominence in the supply chain, sometime between 2003 and 2011 or 2007, let's say, in those years, it used to be Mexico and different countries in Latin America that could play in that position, as well as countries in free Asia. And China really got the gist of the bulk of a lot of that. And China, of course, is where the COVID-19 started. Okay, that's where it started. And some people in China may say it started in Italy, but it would appear to be that it was the tourists from China took it to Italy, and they also took it to Seattle, and so it was a global kind of thing. We're not placing any blame here. We're just saying in terms of where it started, it does look like Wuhan, okay, in China. Whether it was the wet markets or it was the laboratory there, who knows? I can't be bothered getting into it. That's for other people to look at. But the thing is, today, companies are, especially since over the last 2 years, as a result of policy changes by President Xi of China, who is wanting to take the country back closer to a broader prosperity, not broader prosperity in terms of traditional capitalism, but one that leans more on Maoist thought. As a result of that, there have been many changes for global investors that are exposed to China of late. Problems, as you all know, with a variety of companies. I also don't want to get into, because it's not material or a conversation this year in terms of the broader view. But today we are beginning to see companies around the world more actively diversify away from China. It doesn't mean they're not going to do business with China, but they're going to dedicate themselves to opening up globally in terms of their supply chain to other nations. I think it's going to be fabulous for Latin America. I think it's going to be fabulous for Asia, free Asia, non-communist Asia. Should be very good for emerging Europe. And it'll likely also be good for the developed markets in those countries where robotics on the factory floor and algorithms in the offices can provide services and products at a more competitive price. So I'm very optimistic when I look forward to this. I think we've got this transition process. Part of it is diversification away from China, not cutting China out, mind you, but just China doesn't need the world as much as it used to, because it has grown its economy so much in becoming the factory of the world over the last 40 years. as a result of investment of all the world, the free world invested in China, and China took that investment and took proper advantage of it and really has built a phenomenal machine. So when we look at it, look for that diversification. And we think the process for near term is we still have the supply chain is highly dependent upon China. And as you all know from the news, COVID and its variants are giving difficulty to China coming out of the pandemic. It had done better early on in the pandemic. I think they were a lot quicker and a lot better to use masks. So it's such a simple thing, washing hands and masks, and they utilize that. But then later on, they're having trouble with the variants. Part of that is the vaccines in China, as well as the vaccines in Russia, and in the UK, have not proven to be as good as the vaccines that have come from Switzerland and the US. That's just the way it worked out. Okay, that's the way the scientific dice rolled this time around. So we've still got disruption in the supply chains, but gradually that will be remedied. In the meantime, it feeds inflation. Inflation in the US is now running at about 7.9%, almost 8%. Some people think it could go as high as 10 before it completes the spike. So the Federal Reserve has had to begin to end its bond buying program. It tapered it. It will end it this month. And it already began to raise rates by 0.25%. We're looking for about 5 or 6 times on average 25 basis points, we think. We could see perhaps 250 bips hikes. It's a possibility. The Fed chair has already alerted us to that fact on the news yesterday. It was all over on the tape, as we say, which is the news for Wall Street. So what does this all mean for investors? We think it's a better time to invest in equities than in fixed income. Fixed income is being hurt right now because of the fact that at the short end of the yield curve, that which is most influenced by the Federal Reserve's change in policy, rates have risen significantly, hurting the value of short-term treasury paper and high quality and even junk bonds for that matter. But longer term, the maturities have not seen their yields rise that much because the expectations are, even as many people are skeptical if the Fed will be able to bring down inflation, the market seems to be telling us that the market indeed will be capable or the Fed will be capable at reducing inflation significantly. Now, this I can tell you from personal experience, and it's the most valuable thing I believe I can offer you, is in every Fed hike cycle, or even in cycles when the Fed had to cut rates, invariably skeptics and doubters of the Federal Reserve have said the Fed will fail. Could we see the chart on page page 16, the 10-year yield of the Treasury? And what the skeptics always say is that the Federal Reserve will fail at curbing inflation, or it will fail at reviving the economy, that it will produce inflation either way that will inevitably kill the economy and hurt things. And that hasn't been the case. We're still here today. And the US economy, last I looked, is about $22 trillion in size. It is still the largest economy in the world, larger than China, which is about a $14 trillion economy, maybe a $15 trillion economy. So, and the US economy has grown significantly since I got into this business. Here's the chart of the 10-year US Treasury yield. Now, our premise is that interest rates are going up. That cannot be denied. And we expect them to rise somewhat more, but we do not expect interest rates to rise so high that they will produce a lengthy recession or even a relatively short recession. We think we might skirt a recession if they have to raise somewhat higher than one expects, but we don't think it's going to kill the economy. And we think what will happen is it will curb inflation. And we think that in that period, while it's raising rates, as it usually happens, the equity markets, stock markets will likely respond by moving higher. Now, if you look at this goes all the way back to 1965. And in 1965, the 10-year Treasury was somewhere, the yield was around, I don't know, 4.5%, 5%, as you can see from there. But by the late 70s, early 80s, the yield had risen so high that it was almost at 16%. The US had experienced inflation of around 19%. And then Chairman of the Federal Reserve, Paul Volcker, had to take draconian measures by raising rates so high that he crushed inflation, created a very deep recession, and then allowed the economy to rebuild itself. But after that point, the Fed became vigilant against inflation. And as a result of that, look at that. The 10-year yield never saw those yields as high as it did in the late 70s, early 80s. It just kept coming down. There were periods where it tried to come back. Some of those periods were just periods where the bond market thought that inflation was coming back. I can remember speaking with clients, fiduciaries of pension plans, of small and mid-sized corporations in New York City in the mid 80s, in 85, 86, 87. And I can remember at one point having a 10-year US Treasury zero coupon note that yielded 13.4%. I would introduce this to these fiduciaries and suggest to them that they consider it for their plans. Invariably, almost none of them took my idea. And you know why? They said the Fed will fail at curbing inflation. The interest rates are going to go higher because inflation is coming back. Well, it didn't happen. So what happened? Why did this all come down? Is this all the emergency of 2007? No, it isn't. The 10-year yield has been coming down, reflecting vigilance of the Federal Reserve against inflation, lower inflation in actuality, all the way through 2007. And then the levels that you see after that, right through the end of this chart, which is just about 10 days ago when we took this level, what it shows essentially that inflation was not really the issue. And if anything, it was just a matter of finding a comfortable level depending upon where inflation was currently working its way. So if we look at it, the average yield over the past 5 years is around 1.92%. The average yield of the 10-year Treasury over the last 10 years is 2.03%. The average yield over the past 20 years is 2.95%. The average yield over the past 30 years is 3.99%. And to get to 6%, you have to look at the average yield over the past 55 years. So what I'm trying to tell you is this. We believe that inflation that we have today, which is running at around 7.9, 8% into potentially 9 to 10 before it finally peaks as the supply chains become loosened instead of tight the way they are. What we expect is modestly higher rates, not enough to kill business, not to damage refinancing of corporations, may slow the home buying somewhat, okay, because mortgage rates have gone up. But last I looked, the 30-year mortgage is now around 4% from as low as I think 2.5 or so. That's not a lot. I can remember when my first mortgage was 10%. I have friends whose first mortgages were 16 and 22% many years ago, over 40 some years, incredible. But where we are now, we think is in a more temperate environment. I'd like to show you a little bit about the volatility of the stock market and how it actually works out with performance on a historical basis relative to the S&P 500. So Maria, if we could go with that let's go to the Mayan temple first, if we can. Let's go to page 14, if we can. That would be great. When the Federal Reserve begins to raise rates, it doesn't do it all at once. Okay, it starts. It sort of it layers in, and as it does it, it creates a stair-step formation. This is it, and there's the Mayan temple right up on the top. And this shows you what it looked like the last time the Federal Reserve was in a Fed fund hike cycle, because it has a benchmark rate that it works to get to set the rate on that. And if it starts in here, we go all the way back to February of 15. You get to see the way it looks, and you can see that in December of 2015, it began to go up, then it kind of meandered a little bit, but overall, it just kept stair steps. And that's why I say Mayan temple. It looks like a Chichen Itza. If any of you have ever been to Chichen in Merida, Yucatan, outside of Merida, Yucatan, it's those stair steps. And then it flattens out at the top, and then sort of like a ruin of a Mayan temple, that you see the steps, and then it kind of falls off going into the earth in there as the Fed goes back to a lower interest rate policy. But as you can see, the market really went up. And we thought what we'd do is we'd even break it down for you by sectors from between December 16th, 2015, about 2 days, as I recall, before the Fed started raising rates, to December 19th, 2018, which was 2 days after the last time that it hiked. And there it is, information technology, which everybody says doesn't do well when the Fed raises rates. It was up 48.2% in that period. Utilities, which ostensibly suffers from when rates are raised, was up 25.5%. Now, I'll tell you, I think the reason why tech did so well, it's because technology is enjoying currently over the last 10, 15 years, incredible levels of innovation, producing all kinds of changes in the way business and the consumer lives their lives, in our relationships with companies, in our relationships with each other. And so we're all on an upgrade cycle. We're all set to get the next upgrade, so to speak. And I think that has a lot to do with it. With utilities, now utilities suffer when inflation comes on because they buy a lot of natural gas, or some buy coal, or whatever they're buying to create the energy that they sell to their customers. But in the US, the majority of utility companies in the S&P 500 are regulated companies, which means they're regulated by a government authority at the state level. And what happens during inflationary periods is the utility petitions the regulators to raise prices. And what happens, they get to raise the price, so they don't suffer as much from the inflation as expected. And then usually they get hit early by investors, so their yields begin coming up, and then they raise yields as their higher rates enable them to, in terms of paying dividends. And that's probably why you got that 25.5% return. The third best performer, these are the three sectors that outperformed the underlying index, which is the S&P 500, is the consumer discretionary index, up 22.2%. Here's some good news for you. In terms of performance so far this year, information technology and consumer discretionary have suffered, which is one of the reasons why we like those sectors, because we think that they'll likely be good places to find good appreciation over the next 6 to 18 months, and on a secular basis beyond that, because we believe that today, in terms of technology, we are in a secular trend that means a long-term trend, and that secular trend is driven by innovation that we believe is parallel to where the automobile was in the early 20th century, when the automobile began to replace the horse. And it was after Henry Ford had upgraded and he had motorized, or he had mechanized the assembly line. And when he did that, it brought up quality and lowered the price and created the greater affordability of the automobile. And it changed the way business and the consumers not only related to each other, but where they lived and how they worked. Sounds similar with work from home? Interesting. The automobile developed the suburbs, developed the move from the agricultural areas into the suburbs and into the cities. So these are important charts, this the historic 10-year yield, we think, and this revisiting of the Mayan temple. Lastly, let's look at the volatility of the markets so I can open this conference up to Q&A, please. So if we could just go to that other chart, Maria, is going to be found on, where the heck is it? It's on page 13, if you would. And what this chart will show, what I asked my team to produce for me, I asked them to take us back all the way back to 1990, as well all the way back to 1998. I feel these are the modern times, and I wanted to see how the market reacted to these major drawdowns, these pullbacks that you can see. And what we discovered was going all the way back to 1990, There were drawbacks every year, right through the end of 2021. Okay, we always do this to the end of the year, so that's why 22 has empty spots in there, because we don't have an annual price return or a drawdown end date. Okay, that will be applied as a year-end one. But if you look at this, the average drawdown was 13.88%, and that would be the maximum drawdown in a given year from its peak to the low that was achieved that year. It doesn't mean every year there's a 13.88% drawdown to the S&P 500. But I mean, one year in 2021, the drawdown was only 5.21%. And people were complaining, not enough volatility, they said. Well, they got more this year because so far we did have a drawdown of 13.05%. And right now, the S&P has regained quite a bit of that ground. It's only down 5.56% on a year-to-date basis. Is this moment practically on my screen that I'm seeing on the side here. Over the course of from 1998 to 2021, a period which encompasses both the financial crisis and the great pandemic that we had just had, the maximum drawdown is a little bit higher, 15.73%. Now, how did the S&P 500 do in those periods of time? The average return of the S&P 500 from 1990 to 2021 was 9.86%, not including the dividend that the S&P 500 paid in that period. The average from 1998 to 2021 was 8.35%. And remember that 1998 to 2021 once again includes the worst two crises that we've had since the Great Depression. And now it also includes this latest thing, this incursion, but we don't think this is going to be one of the greatest crises ever. So far, it hasn't shown that level of declines. But the average return, 8.35 on that shorter period. And to be noted, that's not including the dividend. So what it shows is the S&P 500 is very resilient. Now, past history is no guarantee of future results, okay? But we suggest that if indeed history may not repeat itself, it shows here it often does rhyme, and perhaps it will again. With that, I'm going to open it up for questions. I very much look forward to hearing from you. Charlie, it looks like you have a question.
Yeah, excellent presentation. First of all, just as a matter of coordination, whoever has a question, raise a hand. Maria will basically lead it out. You spoke about fabulous for Latin America, free Asia, and emerging Europe. I'd like for you to give a little bit of outlook, given that the governments in these countries are so dislocated in their debt structures. I'm curious to understand why you think Latin America would be, a good play. And number two is, what is the role in the future of digital currency, given all this Bitcoin, everything that's going on, all these are alternative currencies that really a lot of people don't even understand them, and how they're going to play a role. And basically, how close are we to the inverted yield curve marking a recession?
All righty. Well, the first thing, let me start, before I go to the cryptocurrencies, let's start with Latin America. When I talk about the opportunity there, it's in the opportunity for the companies, okay, that are there and that are able to manage their way through any dysfunction that exists politically in those countries. For just a matter of fact, right now, if I look at Mexico, for example, and I don't know how you feel about AMLO, but to me, AMLO is not progress for Mexico. Boy, I better watch out if I try to visit Mexico. I better be careful what I say. But if I look at Mexico for right now, if I look at the bolsa in Mexico, the bolsa in Mexico is right now up 5.8% in dollars. In local terms, it's up 4.58% since the beginning of the year. It's outperforming the US. The Dow's down 5.61 and the bolsa is up 5.8. Brazil has its problems, okay? But the Brazilian stock exchange, the Bovespa, is up 26.08% in dollar terms right now. And it has to do with the quality of the companies. So that's what I'm thinking. I mean, look at Chile. Chile's got all kinds of problems there governmentally, which I think are very concerning right now. As long as they don't nationalize the production of copper or minerals and private companies are able to work there and make a profit, it would seem to me that Chile is likely to be able to offer opportunity as well. But when I look at it, if I look at, I'm just looking here, the Chilean market is up, this is in US dollars, is up 23 and 22% year to date. So that's what I'm thinking. And by the way, with these type of gains, much of this may have already been taken, but moving forward, we think as we go forward, we think that the need for commodities in particular, but also to diversify the process of manufacturing away from China, just the opportunity para la comunidad latina es increíble. So that's why I think all of us need to see that we're able to influence the children in education to recognize the importance of a capitalist society and the opportunity that can create for all, compared to the poverty that socialism and communism have proven that they can deliver, from the Soviet Union to Mao Zedong's China and to many socialist governments around the world. What can you say? Related to Bitcoin, Bitcoin is fascinating. And what I find most fascinating with it is the blockchain mechanism, which the inventor forgot to patent. Or maybe he was so busy developing a currency, as he called it, that could be used for nefarious transmission of money around the world by drug dealers and other nefarious proprietors without detection or traceability by government authorities. Now, today, it is becoming, I wouldn't say quite mainstream, but there are segments of investors that like to gamble are involved in it. There are even businesses that have begun to accept Bitcoin as an experiment for some level of their receivables. But at a governmental basis, governments don't like this. China has outlawed it. I believe Russia has outlawed it. I very rarely agree with President Xi of China or Vladimir Putin of Russia, but I must say that I think the idea of outlawing Bitcoin is not a bad idea. I'm sure some people listening may be very angry at me, but my problem with Bitcoin is it has no fundamentals. What one of the great proponents of Bitcoin says, who is a big hedge fund operator, okay, big on the gambling end of the business, the hot and heavy stuff, you know, sweaty palms, just excitement. He says it's because, this is he's speaking when he's interviewed on TV, Bitcoin is worth what it's worth because we say it is, we believe it, intimating that the only reason why the dollar is worth anything is because we believe in it. Well, what backs the dollar, what backs the British pound, what backs the yen, what backs the euro is a system of laws, accountability, a level of transparency and governance, and the economic power of those countries. In the case of Bitcoin, there's nothing behind it except BIPs that are generated from mining with thousands of servers that are bad for the environment, burning energy and creating all kinds of problems, utilizing coal-generated energy and natural gas, even natural gas energy, what have you, essentially polluting more than rather than, you know, producing cleaner production. We just don't get it. So I will say this, most firms will trade Bitcoin for their clients if they like it. I think you'd have to ask Carl Rozak if we have what capabilities we have in that area, but it's regarded as a service because there's different types of investors I've learned in this life. There are those who are very serious that are fundamentally based where they don't buy stocks. Essentially, when they buy a stock, they really look at they're buying a company. They're buying the management, the product or the service, the way that group treats its customers, the way it treats its shareholders, and the way it treats its employees. On the other hand, there's some people who just like to gamble. And is it down? Does it look like a group of people might decide that it deserves to be up? Let's go. The heck with the fundamentals. So Bitcoin fits a spot. Some people love to go to Las Vegas. Some people hate it. And some people like to go for the conferences or even observe gamblers. I've been to Las Vegas on business, and I've gone to the casinos, never played, but I watched the gamblers. I find it very interesting to watch them and watch the crowd around the table and watch how some win money and how some lose money and how they take it. But it's not my game. Any more questions?
Yeah, we have a question here, John, from Jorge Corrales. Says, this is Jorge Corrales from ACO. Excelente presentación. Two questions, please. Do you believe that aggressive rising yields are already priced in for the tech sector? And number two, does that position tech as a defensive player on an environment of increasing recession possibilities? Thank you.
That's an interesting question. I'd say this. I think that the general market had priced in more aggressive actions by the Federal Reserve, and that's why the market rallied after the Fed put in its first hike in the cycle. It's also why it got a little bit nervous yesterday, because it wondered what I would say today. If I look at it, the top performing sectors are right now on the in the S&P 500. The S&P is only up under 1%. It's up 0.98% right now. Communication services, which is 40%, two different companies that are involved in delivery of services, search services, as well as other advertising type services and social media. Communication services up 2%. Financials are up 1.62, with an indication, I would say there, that investment trading firms will likely do well in this environment, but also some suspicion that maybe the yield curve will not continue to invert, but may begin to steepen somewhat. The third best performing sector is consumer discretionary. It's up 1.6%. I agree with that. I don't like to bet against the consumer. And the fifth best is information technology, up 1.38%, or almost 40% better than the 0.99% increase in the S&P 500 right now. So we've got to say, we think that the value in technology is being rediscovered. We think investors in technology need to separate the wheat from the chaff. So when you look at companies, I like to, the way I started with investors, and as a portfolio manager at Oppenheimer, the firm does not really let me get into a lot of names of stocks with clients in this type of a meeting that we're at right now, and with the press for that matter. I can talk sectors, I can talk market capitalizations, growth versus value, international versus US, developed versus emerging and frontier, but not individual stocks. But the way I'd put it, just think of the operating systems, the two major operating systems. This is like charades. Think of the best operating systems, the one that most businesses run on and the one that most households run on, and that the entertainment business runs on and art business runs on. If you look at those are deeply embedded in our society. So we think of those very much as innovators, but they are mainstream innovators, and they are also companies that are acquiring newer innovators to add to their roster. And both of those platforms are highly profitable, as well as growing cash flow all the time. No guarantee that they'll always do this going forward. Past experience, no guarantee of future results, as the disclaimer says. By the way, the worst performing sector right now is energy, down 1.18% on my screen right now. So what we would look at, seeing that, we would have to think that is likely reflective of the fact that people are beginning to think that maybe the energy story is slightly overbought. we would have to feel our favorite sectors right now, by the way, include technology, consumer discretionary, financials, and industrials. Industrial equipment today is riddled with technology because it makes industrial equipment more efficient. It's driven by robotics and algorithms. The digitalization process is extraordinary. But we have to think that materials and energy still have more upside because we think the world is going to continue to grow through this transitional period that has some inflation to be dealt with.
John, we have another question here for you. It says, what strategy or changes would Oppenheimer make to take advantage of the possible rebound? In other words, going forward in this environment, what is the strategy to take on the investment side?
Well, of course, the strategies in particular to any one individual or any one institution, we would say that would be something for them to evaluate with their professional advisors. But when it comes to our broad recommendation for consideration, we have consistently been overweight US, yet meaningfully exposed to both developed and emerging markets on a global basis, where we feel valuation and the likelihood that those regions will benefit when the US economy achieves a sustainable economic expansion coming out of this COVID-related transition. We would have to think beyond that. We think you want to own both growth and value stocks. You want to own growthier value, so you want to avoid the value traps, those companies that are just value because they borrow to pay their dividends and they're scraping along because interest rates are low, they can make it. No, we want to look for growthier value, those value companies that use innovation to improve their products and their services. And as a result of that, attract business to them and attract investment. We also like GARPier because we're using growthier value. We got that IER, we got to go GARPier instead of just GARP, but growth at a relatively reasonable price, technology, which are the mainstream technology companies that have proven their profitability as well as their ability to grow cash flow, and many of them even pay dividends. We also like, we prefer not to get defensive here. We prefer cyclicals to defensive sectors. So we like sectors that are highly sensitive to economic growth, because we think better, more sustainable economic growth is achievable. We think, we're going to come off the high levels that are mostly the result of easy comps or comparables that we've seen from pandemic low growth to much faster growth as the economy heals. But a good consistent growth, 2.5%, 3% growth, kind of an economic environment, we think is good for cyclically positioned companies.
Another question, John, and I just want to mention to everyone too, is that John has been here to Panama as before and met with certain clients and actually spoke at a conference here in Panama. So he's well adverse to how Panama operates and the beauty of Panama as well. And he enjoyed it very much. I know that.
I love Panama. Me encanta Panama y ojalá volver pronto a visitar con ustedes en persona.
Ojalá que sí.
Ojalá, sí.
A question here is, how do you feel about the broadening gap between tech indexes and trillion-dollar companies like Microsoft and Apple?
Well, the Microsoft and Apple are both part of the technology indexes. The difference is, if you compare, it depends on different type of indexes of technology. If it's greenfield, new versions of technology that are coming up, the differentiation tends to be in the establishment of a history of profitability and success versus new innovators who have a promise that they can do something. That would be the only way that I would differentiate it. But the technology indices that we generally use, we use the NASDAQ 100, the Qs. We also use the XL, the XLK, the technology index. Check your tickers with your advisors, please. As I use a lot of tickers, I don't want to give you a wrong ticker, but But we use broad indices within those areas to gain the momentum when we use ETFs. In individual stocks, there we're highly selective. We tend to look for companies that can actually pay a dividend and a history of growing dividends too. And we have we've got a lot of happy customers. Past results, no guarantee of future results.
Okay, I got my one last question. I mean,
Yes.
I've been looking around at the yield curve and it's very close to being inverted.
Yes.
Given that, you know, consumption will slow down because of all the inflation related problems, how long do you forecast the recession to last, and basically how can we pivot to that right now?
Well, I think that a couple of things. One thing is an inverted yield curve does not guarantee a recession, though it often has signaled a recession ahead. The last time I can remember a significant period when the yield curve was inverted over a period of years was ahead of the financial crisis. It was an amber light on the dashboard, okay? But it was not actually a guarantee of any kind of a recession. The guarantee was essentially all the irresponsibly issued mortgages, all the ABS, asset-backed securities that included patchy, questionable mortgages on them that were held by banks. Those were the guarantees of a recession. So I can't say that we're going into a recession. I would have to say this: when the yield curve becomes inverted, one of the reasons why is because what investors look at in the bond market is what does the Federal Reserve really have effect over on the yield curve? And the yield curve being that point of from the left to right on a chart of at the lower end is your treasury bills, your 2-year notes, your 5-year notes. And the midpoint would be the 7 to 10 years. The longer end is 10 to 20, is over 10, 20, and 30 years. And what it's telling us, in effect, is very normal, is that long-term inflation does not look like an issue right now to the bond market. But short-term, it certainly looks like the Fed is going to raise rates to battle this inflation. And that's why the yield curve has flattened, because people are selling short end treasuries, then they're either buying the long end or they're putting the money elsewhere. So I think, I think we could skirt a recession if the inflation that we have becomes stickier than the Fed chair has believed it could be. But I don't think, I'm not looking for a hard landing, though we might get a little bit of bump in the landing, much like periods like this in the market are when you have, if you're on a commercial jetliner and the pilot comes across and says, please fasten your seatbelt because we have some turbulence ahead. 99% of the time, it doesn't mean the plane's going to crash. And probably even more than that. It's probably 99.999, who knows what. I haven't looked at the math on that, but you generally, you're going to land. But you might experience some level of uncomfortability to any different extent. I've been on planes where I thought the wings were bending. It was that the landing was so rough. And I've been on landings where, when you hit, boom, you feel the wheels and the landing gear hit the tarmac, and woo, people kind of holler and all. But it's you don't crash, So it's similarly with a recession and a hard landing. Hard landings have been predicted more times than I can remember over my history in these markets. Not that I was involved causing hard landings or no hard landings, but generally speaking, if you don't get a soft landing and you get a bumpy landing, it's better to be a participant in the markets than not, from my experience.
John, we have one last question because I know you have to leave. It says, what do you think about financials? On one side, they do fine while rates rise. On the other side, spreads between short and long-term rates are shrinking and might affect margins. Your opinion on that?
Yeah, of course, when you get a squeeze like this, it's going to affect margins in terms of their lending business. But since the breakup of the Glass-Steagall Act, when the heck was that? That was a long time ago. It was during the Clinton administration. Most of these banks are involved in all kinds of trading and building of different types of investment products. So whether it's trading in the bond business can increase, trading in the stock market can increase, options, different things. I think there's more ways for banks to make money. Issuance of credit cards. Has anybody looked at the interest rate that banks charge on their credit cards? Even if you're a good customer, oh my gosh, if you or I charged each other that for a loan, they'd put us in jail. So they know how to make money. The thing is, they may not make the next gains as a result of an inverted yield curve or a relatively flat yield curve. But it was steepening before. The problem is the perception of what the Ukraine situation will do to commodity prices and adding to inflation risk has added another level of concern. We'll just have to see how that works out. I still like financials because the world moves by credit. And so long as the economy is doing well and people are buying stuff, people are going to borrow money.
John, thank you very much for your time. We hope that next time that we do this, it's not via Zoom, but it's in person here in Panama.
Here.
That would be a great feat. We'll even try to get you. John's plays guitar, plays it very well in a band, and maybe we'll get you on stage to play also.
That's a good
Oh,
idea.
that'd be something else. That'd be something else.
And thanks to Carl too. I don't know if Carl wants to wave us goodbye, but he's in charge of the full relationship with Oppenheimer and everything. So I really thank you for your time and everybody who participated.
Yes. Thank you much, everybody. Gosh, I see we have 29 participants on the call. How wonderful. Bye now.